Hello, and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about all of the things required to transform the global business and investment communities to create wealth on an ongoing basis in ways that enhance the well-being of the individual, the wider community, and the environment. So hopefully you're following along with me on YouTube. Please subscribe to the YouTube channel. I've created a playlist where you can follow from beginning to end. There's quite a few videos coming up. And basically what I'm doing is I'm telling the story incrementally, one little sliver at a time. It's like peeling back the layers of the onion. And the reason why I'm doing that is because the topic of ongoing wealth creation is so expansive, and the transformation required to seriously achieve it, particularly in ways that fundamentally benefit humanity, which is really, it's got to be the ultimate objective. I mean, if we're not in business to ultimately uplift humanity, then why are we in business? And the shift in paradigm between the shareholder primacy paradigm and a more expansive, inclusive paradigm where being in business is an opportunity to be of service to society, not to just make as much money as you can, almost regardless of how you do it. That fundamental shift in paradigm is occurring. It will be accelerating. And the reason why it will be accelerating is because a much larger proportion of humanity is awakening to the realization that they are part of a bigger collective. And so simply maximizing, individual benefit almost to the exclusion of all others really just doesn't make sense. And so as more and more people wake up to this reality, then the kinds of businesses that are operating heavily dominated in the old paradigm, the shareholder primacy paradigm, basically will become irrelevant. They won't have a relevance in the market anymore. And at the end of the day, they will fail. They will destroy shareholder wealth. And the board members and the CEOs and the executive teams that are at the helm of these companies that refuse to make the transformational shift will be sidelined, within their careers. Now, I don't have a crystal ball. I don't know exactly when all of these things are going to happen, but I think a lot of people are beginning to realize that there is an inevitability in all of this. And so it's like, are you going to be on the leading edge of it, or are you going to be a victim of the shift in paradigm when you look around and you go, oh my God, what just happened? Well, all of the breadcrumbs are out there. And that's one of the reasons why I'm making all of these videos and putting together a global movement to enact this transformation, quite frankly. So please subscribe to the YouTube channel, share on LinkedIn, in all the sort of pages and groups that I post into, and follow along, particularly sign up for the playlist, because there is an evolution of thought going through the whole series. So in a previous couple of videos, I have talked about a lot of the corporate finance underpinnings of business valuation, how that relates to wealth creation, and what the nature of ongoing wealth creation is. So please go back to a couple of videos. I won't be going through those or rehashing those concepts in detail, but what I have found useful at the beginning of each video, before I get into the main content or the main focus of each episode, is a little bit of a recap, just so that people can just refresh and follow along with me. So why don't we do this? I'll share screens. We'll do a quick recap, and then we'll move on to the real juicy part of this conversation. So just bear with me for 1 second while I share screens, and hopefully that is up on your screen. Okay, I want to rehash very quickly the notion of wealth creation, and particularly ongoing wealth creation. And so go back a couple of videos if you want to get the detail of it. But axiomatically, and the interesting thing is not everyone, well, not a lot of people actually know this. A lot of people talk about wealth creation, but they don't really know what it means. So can I give you the proper understanding of wealth creation? Wealth creation occurs over a period of time. And in the example that I'm giving on this page, there is a first measurement period from 2021 to 2023. That's this part of the chart. So there's a 2-year measurement period from 21 to 23. And then there is a subsequent measurement period from 2023 to 2025. Okay, so there's two-year measurement periods. And in the first measurement period, wealth creation occurs when over those 2 years from 2021 to 2023, the board and the executive team engages in a deliberate combination of strategic, growth, operational, and tactical actions to cause the value of the business at the end of those 2 years to be greater than what it was expected to be in the same time period. And if I know the value of a company at any point in time, I sure as hell know what it is expected to be at any time in the future. And the simple linkage between value today versus the expected value at some point in the future is the cost of equity. And so you need to go back a couple of episodes to understand that. So in this example here, $190 million was created over the 2 periods from 2021 to 2023. And that $190 million in percentage terms represents a compound annual growth rate in wealth creation in percentage terms of 9.1% per annum over those 2 years. And that's fantastic. But the name of the game is ongoing wealth creation. So having succeeded in creating wealth over 2 years to 2023, the challenge now is to create wealth again over the next, for example, 2-year measurement period. And so again, wealth creation occurs when over 2 years from 2023 to 2025, the value of the firm is greater than that which was expected to be in 2025. Here, there is a wealth creation, a dollar amount of wealth creation of 181 million, and that represents in percentage terms 5.2% per annum over those 2 years, which is a good level of wealth creation. Now, at the end of the day, what this wealth creation means is that the returns to shareholders were, in this case, 5.2 percentage points greater than the cost of equity. And bear in mind that the cost of equity defines the expected level of shareholder returns, right? And when you achieve the expected level of shareholder returns, you're wealth creation neutral. So in this case, we're generating 5.2% per annum in excess of the expected return or the return that shareholders expect. And that's a good number. And I'm going to come back to that from an investment perspective a little later. So that's all I want to say about that. The next concept that I've introduced in previous videos is that most of the corporations that I kind of talk about, which are large listed multi-divisional, potentially global organizations, have a portfolio of businesses or customer segments. And so the real name of the game of ongoing wealth creation is to understand the strategic position of the portfolio of your businesses. And here is a strategic characterization framework popularized by Maricon in the Value Imperative back in the day, so about 20 or 30 years ago. But it's a fairly common strategic assessment framework. But the point here is that if you want to create wealth on an ongoing basis, you really need to be sort of thinking about parts of the business and your strategic actions in various parts of the business. And yes, of course, you need to think about the portfolio as a whole, but predominantly you're operating at a disaggregated level. And so there is a strategic characterization of the portfolio of businesses that leads to a financial characterization. So here are value creating segments, here are value destroying segments, and here's one that's sort of fairly value neutral in that sense. And so the name of the game is to implement strategies that make the value creating segments more value creating and the value destroying segments less value destroying. And then, of course, it is open to enter new segments and offer new products and services and new segments to make the portfolio bigger in number. So that's the name of the game. I also spoke about a systematic and structured approach to large-scale business transformation and ongoing wealth creation. And so very quickly, go back to the previous episodes for more detail, but there is a series of activities to be able to a capability around value measurement at a disaggregated level, because wealth creation is all about value uplift. So you want to know what you're doing to cause value uplift, right? So there is a value measurement series of activities that take place at a disaggregated level. And this is sort of a little bit in the corporate finance domain. It's the numbers side of things. It's the left brain side of things. Then there's a whole bunch of blue ribbon activity, which is really the engine room of ongoing wealth creation, which at the end of the day is fundamentally about creativity and innovation and commercializing that in a systematic way within the organization. And then there are a bunch of strategic management processes, beginning with strategic planning and then resource allocation, target setting and budgeting, performance management. And the last thing is executive reward. And I'm going to talk about executive reward in a dedicated separate episode, because there's a lot to be said about that, because it's a real mess at the moment. But there's a simple solution. So stay tuned for that one. And then overlaying all of this in a warp and weave sense is a whole bunch of work that needs to be done at the people, culture, systems, processes, organizational level. It's the human side of strategy execution. And there really is a lot of work to be done. So those that are in the people side of large corporates, in HR, in executive coaching, in sort of group dynamics, there's a lot of work that needs to be done in that. So if you're in that side of corporate life, please get in contact with me, because there's a whole lot of really interesting work that we can be doing together beginning right now. But can I just say one thing before we move on to the next slide? And that is that a lot of boards and CEOs, they realize that they need to implement a cultural improvement process or a program, and they spend millions and millions of dollars. They engage, big fee generating consulting firms. The problem that a lot of these things do is they try and create a culture and an organization without real reference to the purpose and the mindset and the intent and the ideas that underpin it. So it really, from my perspective, feels a lot of like putting the cart before the horse. So if you're going to be doing this, I really encourage you to get in contact with me, because cultural change, absent of, the left brain side of strategic corporate management, is just in a vacuum. And these aspects, which is, let's call it the hard science of strategic management, and the maroon ribbons, which is the softer science of corporate strategic management, really do need to operate together. So, it doesn't make a lot of sense to do culture absent of a bunch of other things. So there really is a good, systematic, structured approach for ongoing wealth creation, but there's a lot of moving parts. I've been working in this space for 2.5, 3 decades. I've got a lot of insights as to how to do this. So please get in contact with me, I think is the point about that. The other thing that I would say is that ongoing wealth creation, in the way that I described on the previous slide, requires a lot of really integrated capabilities. And it begins with board governance. And we can talk about board governance more in another episode. But fundamentally, board governance, the purpose of governance is the governance of purpose. So if the board is unclear as to what its corporate purpose is and how that needs to be executed, then any kind of board governance is most likely going to be more in the compliance space of things. Not to say that compliance isn't important, but there's a lot more that boards can be doing to take the leadership position, because they are the stewards. At the end of the day, the board is the steward of the ongoing success of the corporation. And so, the board really needs to be thinking very hard about what they need to do to set the conditions within the organization for ongoing success. And ongoing success here really means ongoing wealth creation, systematic, sustainable, in ways that ultimately enhance the well-being of the individual, wider community, and the environment. So board governance is incredibly important. It is the center of a whole bunch of cogs that includes strategic management. And strategic management here, in an ongoing wealth-creating sense, is so different to the way most organizations do strategic management that there's a lot of work to be done in putting in place a structured, systematic approach to strategic management. And of course, that dovetails into operational effectiveness. On the other side of the coin is the culture and leadership and the innovation capability side of things. And these things are the sort of softer parts of the ongoing wealth creating equation. I've previously said that when I rate it on a scale of inappropriate, ineffective to that required for ongoing wealth creation, and notice that I didn't say best practice, because if you go out there and you look for best practice, even best practice, in my view, will fall well short of what is required for ongoing wealth creation. So we're really looking at this from a much higher vantage point than traditionally being thought through. And on all of these critical dimensions, these organizational capability kind of dimensions, most organizations in aggregate, if I was to sort of scan around the entire world, most organizations on most of the dimensions are operating well, to the left of what, even, if you're very generous, it would be a mid score on things. So the point about that is that there's a lot of work to be done. Okay, so that's that bit, and that's traditional, sort of, in a traditional paradigm. But under the new paradigm, there's some additional, or a set of core principles that will define a second dimension of what's required in order to be really, really top tier. So let me just quickly go through these 6 summary principles of ongoing wealth creation. And this is in ways that enhance societal well-being. Okay, so here we go. The first thing is you really do need to adopt economic measures of performance. And so the 2 economic measures of performance is economic profit and its derivative, economic profitability, which is returns. That is the apex measure of performance for internal company financial performance, and it comes from the P&L and the balance sheet. So there's, it's just a slight adjustment to the way people are currently thinking about it, but it really is important to adopt economic measures of performance for internal company performance. And then the apex metric of performance in the capital markets is wealth creation, which is total shareholder returns less the cost of equity. And the important thing here is that it is only possible to link company performance, which is financial performance, with capital market outcomes when you adopt economic measures of performance. Now, the very, very vast majority of organizations around the world do not currently adopt in a systematic way economic measures of performance. So they are operating completely blindly of the linkage between what they're doing in the company and the financial performance, and how that links to strategy and actions versus the outcomes for shareholders in the capital markets in a fundamental sense. And so there's a complete blindness between these things. And when you're blind on these things, it is no wonder that the vast majority of organizations are, they're like rabbits caught in the headlight. They don't know how to move, because it's almost like, it's just a random walk for them. Okay, so that's that. The next core principle is that there must be a primary focus on the long term, and a focus on strategy and strategic management. Now, way too many organizations spend way too much time worrying about the next quarter's earnings, or the next financial result, and then they undertake short-term sort of profit improvement actions, which really is devoid of strategy. That's the first thing you need to know about that. And the second thing is that it can be, and often is, very damaging to the long-term health and success and wealth creating ability of the organization. And fundamentally, organizations that manage themselves by the numbers, right, where the CFO and the finance organization is almost like the masters of the universe, you're really denuding the fundamental driver of long-term success in the organization, which is people and creativity and innovation of those people, put together with a focus on commercial outcomes. So you really do need to have a primary focus on the long term, and we can say more about that in other episodes. I've already alluded to, which is the next principle, the central role played by creativity and innovation. Here's the short answer. The primary driver of ongoing wealth creation is creativity and innovation, full stop. And so boards and executives and the CEO really needs to think very hard about how they're going to institutionalize creativity and innovation in their organizations. And I can assure you that a lot of HR management processes, systems, and structures really aren't up to the challenge. Okay. The next principle is that there is a need to focus on all stakeholders. And you'll have heard me say many times that at the end of the day, from the actions of the corporation, it is necessary for long-term success to enhance the well-being of the individual, the wider community, and the environment. And it's only in doing that you will ultimately, in the long run, in the paradigm shift, create wealth for shareholders in any sustainable way. So the paradigm shift is thinking about, what is the purpose of this organization, and how, and here we go, we're going into the next core principle, which is that there needs to be a clear purpose underpinned by a noble intent. Now, recently, a lot of academics and a lot of authors have written a reasonable chunk of books around the topic of purpose, and that's great. But it's not just any old purpose. It is a purpose underpinned by a noble intent that is required. And it's the nobility of the intent that really matters in the long run. And so companies that operate, and a real noble intent is that everything that the corporation does, from the products and services that it puts in the market, the way that those are manufactured or created, and the way that they are distributed, ultimately, fundamentally, significantly enhances the well-being of the individual, the wider community, and the environment. And anything that you're doing that doesn't do that is an impediment. And so one of the things, and we'll talk about this in a second, but one of the things that organizations, boards need to do very, very early in the piece, in the transformation piece, is to recognize which parts of their business, and that includes their products and services, the way that they are manufactured and distributed, which parts of their business and their business model are no longer fit for purpose. And what's going to really challenge a lot of boards and organizations is how to transition out of those legacy infrastructure and investments and transition into products, services, manufacturing, distribution, logistics, supply chain capabilities that are fit for purpose under the new paradigm. And so I'm going to talk about that a little bit some more in more episodes. The final of the 6 core principles is a realization that more is not always better. Now, under the shareholder primacy paradigm and the corporate governance framework popularized by the thinking of Milton Friedman and the Chicago School of Economics, it's dominated in the idea that more is always better. Therefore, what I need to do is shoot the lights out and create more profit, and particularly more short-term profit. And so a real realization is that that's not true. More is not always better. There is an optimal level of economic profitability, and there is an optimal level of wealth creation. And just remind yourself that those are the 2 apex measures of economic performance: economic profitability in company performance and wealth creation in the capital markets. There is an optimal level of both of those metrics beyond which you as an organizer, if you're seeking to create a higher level of economic profitability and growth and a higher level of ongoing wealth creation, the attempt to do that is likely to lead you down the slippery slope away from your underlying purpose. Okay, so there is an optimal level of these. And one of the insidious things that is currently going on within a lot of organizations is that A, they don't understand this, and B, they operate incessantly to break those 2 conditions. And in a lot of ways, it is what drives them into a pathway of ultimate decline. And so that's an understanding that boards and executives and CEOs, they need to kind of get around to very quickly in things. So I'd like to introduce you now to an assessment framework which I've been putting together for a reasonable chunk of time in 2 dimensions. So the first dimension, the horizontal dimension, is a dimension that I'm calling the Organizational Capability Index rating. So it is an assessment of the kinds of things that we've spoken about already. So the mainstream kinds of things around board governance, strategic management, operational effectiveness, culture and leadership, and innovation capabilities. And it is a fairly obvious statement that in order to be a top tier ongoing wealth creating organization, you want to have a systematic and integrated approach to all of these things that are towards the right-hand end of the spectrum of that which is truly required in order to be best practice. And so, when you aggregate all of these individual metrics together, we can have an aggregated OCI rating. And, to be honest, you want to be on the right-hand end of that spectrum. All right, that's that. But there's another dimension, and a very important dimension, and this is the vertical axis. I call this the cause rating. And cause is an acronym for commerce acting to uplift society. And then, so that's the CAUS, and the E is exponentially. So commerce acting to uplift society exponentially. The exponential, and by the way, it's just a cute term, but it resonates, because you want to be the cause of positive outcomes, not the effect. There's a whole bunch of sort of in a vibratory sense, resonant things around the term cause. The exponential part of cause is operating from a higher vantage point, and a vantage point around being of service to society. And so the dimensions, the elements of the cause rating dimension is the mindset and intent of the board, the executives, the extent to which that mindset and intent, which includes purpose, is fully embedded from the boardroom down to the shop floor, and the extent to which the lived experience in the organization reflects a mindset and intent grounded in a purpose of a noble intent. Okay, so mindset and intent is really important. The next element is the nature of the products and services on offer and the extent to which those truly enhance the well-being of the individual, the wider community, and the environment. Let me just say a few things about this. Consumers, customers and consumers obviously consume the products and services that organizations put on offer. And if the consumption of those does not enhance the well-being of the individual consuming them, then they're going to get a fairly low rating on that aspect of that dimension. And so we can think about lots of things, products and services that are on offer in the market, which, look, at the end of the day, really are not good from a consumption purposes for the individual. Okay, so that's consumption for the individual. Now think about the wider community. There are many food items on offer, manufactured food, sugary soft drinks, all sorts of other things, the consumption of which not only is not good for the individual, but at a more collective level, it really isn't good for the wider community. And here I'm talking about adverse health outcomes leading to externalities around, the need for healthcare, expensive healthcare, which the providers of the products and services leading to these poor health outcomes are not paying for. They've externalized that to society, the wider community. And then, of course, the consumption of products and services can have a detrimental impact on the environment. And one aspect here might just be, plastic wastes in sort of single-use product packaging, those kinds of things. All right, so there is an objective assessment that can and should be made in relation to the extent to which the products and services on offer by this company enhance or otherwise the well-being of the individual, the wider community, and the environment. So the next dimension is the production and distribution approaches, right? So how are those products and services produced in the first instance and then distributed in the second instance? And this will, give rise to things like, the labor force, how employees are treated in the organization, the environmental waste and degradation coming from production, very long distribution chains with, very large air miles or sea miles, electricity consumption, and particularly, fossil fuel-based consumption, environmental degradation, all of those kinds of things. And the third dimension is the economic sustainability aspect. And it talks to the last point we had on the previous slide, which is around the notion that more is not always better. In other words, is there an appropriate economic outcome from the operations of the business? Now, can I just say one thing on this, and then we'll quickly move on and wind down a little bit. There are a lot of organizations that have created very, advantaged strategic positions in which they are generating very high levels of economic return, economic profitability. And so when you're generating such high levels of economic profitability, you really need to be asking the question, are you pricing too high, or are you not reinvesting enough in the business? So that's just something to think about. You need an appropriate level of economic profitability, and I'm going to suggest in the order of 5 to 10%. But there are a large number of organizations around the world, particularly the digital monopolies, particularly in the US, which are generating very, very high levels of economic profitability. And one thing you can say about that is that when you're operating at such high levels of economic profitability, any attempt to increase economic profitability even more will likely lead you to do things that are, counter to the kinds of things that we're talking about in the new paradigm. And so there needs to be an appropriate reflection of economic benefit of the organization across all stakeholders. And when you've got very high levels of economic profitability, there's a high likelihood that there is something a little bit unbalanced. And when something is unbalanced, it's not sustainable. And so institutional shareholders need to be concerned about that, because there's a very high probability that things are going to go south. And when they go south, you're going to be destroying wealth. So there you go. That's a two-dimensional assessment matrix that I've been working on. And I'm going to talk about a little bit down the track as to some things that can be done to really operationalize this framework, so we can make an assessment of tens, 20, 30, 50,000 companies worldwide and position them on this matrix. But let me get to that topic in a second. The last thing I want to say to you is that when I think about things from a broad perspective, my basic intuition says that the very vast majority of organizations around the world, and I'm talking about at this point, I'm talking about the very large listed corporations or the very large private corporations, are going to be kind of dominated in the bottom half of this matrix. And so they've got a very a less than a less than ideal cause rating. In other words, they're heavily operating within the old paradigm. Some organizations are going to have very high capability index ratings, so they're very good at what they do, but they'll be the old paradigm winners. So there's going to be a good chunk of organizations that are dominated roughly around here in the matrix. Now, I think it stands to obvious reason that if you are dominated, or if you are positioned, having done an objective assessment on all of the elements of the rating system, if you are positioned towards the bottom left of this quadrant, it really isn't a good place to be. So not only will you have a low, from a fundamental sense, a low market to book ratio, and therefore a low valuation. So not only will you have a low valuation relative to others, but there is a very high likelihood that things will continue to deteriorate, and therefore there is a very high risk that you will be destroying wealth for shareholders, regardless of poor outcomes for the individual, the wider community, and the environment. And so institutional shareholders ought to be very concerned about holding long-term investments in companies that are positioned down here. That's the first thing. But secondly, particularly companies that are unwilling or unable to undertake the transformation required to get out of that quadrant, because that is a quagmire quadrant. Trust me, you don't want to be there. Being on the bottom right might be okay for the short term, but ultimately where you need to be doing, regardless of where your starting position is, you need to be heading towards the top right quadrant. And these are organizations that are operating well within the new paradigm of being in business is an opportunity to serve society, and they have embedded within their organization the kinds of capabilities which I've described a number of times now, which allows for ongoing wealth creation, the harnessing of innovation and capability dominated in a purpose underpinned by a noble intent. So I think I'll hold over to the next episode an opportunity to operationalize this framework in a systematic sense. So let me stop sharing. That was a bit of a run through. So the important thing here is that the aspiration for all companies is a couple of things. One, recognize where you currently are on the cause OCI matrix. And at one level, it doesn't really matter where your starting point is. It's just that if you find yourself in the bottom left, it's a real call to action that there is an immediate need to start thinking about the dimensions of the transformation you're going to need in order to get out of that bottom left quadrant, because you don't want to be there. So it doesn't really matter so much where you're starting from, but recognize, the first thing is recognize where you are, because that's really important. And then secondly, plan the things required to move towards the top right of the quadrant over a period of time. And I understand that the transformation required here, particularly in large corporations, it's like trying to turn an oil tanker around, right? So they won't be turning around on a dime. They're going to be turning slowly and systematically and in a structured way. And the important point here is that I've developed a systematic and structured approach to undertake this transformation so that it is not earth-shattering. It is, it is deliberate, yes. It is well-funded, yes. It requires a significant amount of investment, yes. It requires courage and leadership, yes. And it requires a commitment to doing these things. And in other episodes, I'm going to be talking about the role that institutional investors can and should play in encouraging companies to undertake the transformation and then to support them through the transformation process. And so understand that the transformation that I'm talking about is very systematic, structured. It might take 3 to 5 years to fully implement. And in the transformation side of things, there's a number of things that boards really need to start thinking about, very quickly. So here they are very quickly. Number one, what is the purpose of our company? And, ultimately you need to be describing that purpose as being underpinned by some noble intent to be of service to society in producing and distributing your products and services. We've spoken about that. The second thing is, what is the board's role in setting the conditions necessary to achieve that purpose? And so there's a lot of thought that is required about how the board operates, and it's going to be, in the new paradigm, quite different to the way a lot of boards operate. The next question is, how can the board be sure that management is faithfully and effectively acting on that purpose? And so if you come back to this video, the orange set of ribbons describes a set of strategic management processes that when put in place will allow the board to have the appropriate stewardship of the corporation and the executives which are basically employed to implement the purpose that the board signs up to. The next thing is, what is the nature of the transformation required in order to transition to that purpose and ultimately move to the top right-hand quadrant of the cause OCI matrix? And then lastly, how should the board engage with its institutional investors to ensure their support during that transformation process? And so I think I'm going to talk about this a little bit more in another episode, but there's a lot of really big picture things that need to be done in order to move from, your starting position to the top right. And then once you're kind of there, at some point in the about a 1/3 part of that transformation process, it would really behoove organizations to start working on the OCI dimensions, the board governance, strategic management, operational effectiveness, people and culture, innovation capability, to make that engine really hum so that it gives you the best opportunity for ongoing wealth creation. So thanks for tuning in. There's a lot for today, and we'll keep the conversation going. So please subscribe to my YouTube channel. Just search for Valuation Insights on YouTube, and there's a playlist that will allow you to play through these videos from the beginning and follow along with us, because there is some logical series in doing these things. So thanks again for tuning in, and bye for now.